A unit-linked insurance plan, or ULIP, is a special kind of financial product. It does two jobs at the same time. It gives you life insurance cover, and it also helps your money grow through investments. Think of it like a combo meal. You get the main course, which is the life cover, but you also get a side dish, which is the investment part. This mix is what makes a ULIP different from other insurance plans. It aims to protect your family's future while also building wealth for your long-term goals. It's designed for people who want both safety and growth from a single plan. Understanding a ULIP is simpler than it sounds. When you pay your premium, the insurance company splits the money. A small part of it goes towards your life insurance. This is the cost of protecting your loved ones if something happens to you. The rest of your money is invested in the market. This investment part is linked to funds, similar to mutual funds. The value of your investment can go up or down, depending on how these funds perform. This is why it is called unit-linked. Your money is linked to the performance of investment units. This dual nature is the core idea of a ULIP. Let's imagine you decide to pay a yearly premium of 1 lakh rupees. From this amount, the insurance company might take out a small portion, say 5,000 rupees, for your life insurance cover. This ensures that if you pass away during the policy term, your family gets a pre-decided sum of money, called the sum assured. The remaining 95,000 rupees is then invested. You will have a choice of where this money goes, based on your comfort with risk. This structure allows you to see exactly where your money is going, separating the insurance cost from the investment portion, offering a level of transparency. The main goal of a ULIP is to offer a complete financial solution. It combines protection and wealth creation in one package. This is useful for people who are planning for long-term goals. These goals could be anything from your child's education to your own retirement. By paying a single premium, you are addressing two important financial needs. It simplifies your financial planning. Instead of buying a separate insurance policy and making separate investments, a ULIP lets you do both together. It's a structured way to stay disciplined with your savings and investments over many years. The dual function of a ULIP is its most important feature. Let's look closer at the two parts, insurance and investment. The insurance part is straightforward. It is a life cover. If the policyholder passes away during the term of the plan, the insurance company pays a death benefit to the nominee. This amount is usually the higher of the sum assured or the value of the investment funds. This ensures that your family has a financial safety net to rely on. This protection element is the foundation of any ULIP, providing peace of mind from day one of the policy. The investment part is where your money gets a chance to grow. The premium you pay, after deducting charges and the cost of insurance, is used to buy units in a fund of your choice. Think of it like buying shares in a company. The price of these units is called the net asset value, or NAV. As the value of the assets in the fund goes up, the NAV of your units also increases. This is how your investment grows over time. You are essentially a part owner of the fund's assets, and you benefit from their performance in the market. Let's use a simple example to see this split. Suppose you pay a premium of 50,000 rupees for your ULIP. The company might deduct 2,000 rupees for the life cover and another 1,000 rupees for other charges like premium allocation and policy administration. The remaining 47,000 rupees is then invested. If you choose an equity fund and the NAV of one unit is 10 rupees, you would be allotted 4,700 units. If the market does well and the NAV increases to 12 rupees in a year, the value of your investment would become 56,400 rupees, showing a clear growth. This combination of insurance and investment works together over the long term. The insurance component provides a stable layer of security. The investment component offers the potential for higher returns compared to traditional insurance products. This structure is designed to help you meet your financial goals systematically. While the insurance part remains constant, the investment part is dynamic. It moves with the market. Your role as an investor is to choose the right funds and stay invested for a long period to see meaningful growth in your wealth. One of the biggest advantages of a ULIP is the flexibility it offers. You are not a passive observer. You get to decide where your investment money goes. ULIPs offer a range of fund options to suit different types of investors. The most common types are equity funds, debt funds, and balanced funds. If you are young and willing to take more risk for higher returns, you might choose an equity fund. These funds invest primarily in stocks and company shares. They have the potential for high growth, but also come with higher market risk. On the other hand, if you are a more cautious investor, you might prefer a debt fund. Debt funds invest in safer options like government bonds and corporate debt. They offer more stable and predictable returns, but the growth potential is lower than equity funds. These are suitable for people who are nearing their financial goals or have a low-risk appetite. The aim here is capital preservation with modest growth. It's a safer path for your money, shielding it from the high volatility of the stock market. You choose the fund that aligns with your financial personality. Many people prefer a middle path. For them, there are balanced funds, also known as hybrid funds. These funds invest in a mix of both equity and debt. The proportion can vary, for example, 60% in equity and 40% in debt. This strategy aims to provide the best of both worlds. You get the growth potential of equities along with the stability of debt. It helps in balancing the risk and return in your portfolio. This is often a good starting point for new investors who are unsure about taking on full equity exposure. The best part is that you are not stuck with your initial choice. ULIPs offer a feature called fund switching. This allows you to move your money from one fund to another within the same plan. For instance, if you start with an equity fund and later feel the market is becoming too risky, you can switch your money to a debt fund. Most insurance companies offer a certain number of free switches every year. This feature gives you active control over your investment, allowing you to adapt your strategy based on market conditions or changes in your own financial situation. When considering a ULIP, it's important to look at both sides of the coin. The benefits are quite attractive. First, you get the dual advantage of life cover and investment growth under a single plan. This simplifies financial management. Second, ULIPs offer the potential for significant wealth creation over the long term, especially if you choose equity-oriented funds and stay invested. Third, they come with tax benefits. The premiums you pay can be claimed as a deduction under Section 80C of the Income Tax Act, and the maturity amount is often tax-free under Section 1010D, subject to certain conditions. However, ULIPs are not without their risks and drawbacks. The primary risk is market risk. Since the investment part is linked to the market, the value of your funds can go down as well as up. If the market performs poorly, your investment value could fall. Another point of concern is the charges. ULIPs have various charges, such as premium allocation charges, policy administration charges, and fund management charges. While newer ULIPs have much lower charges, it is crucial to understand them before investing, as they can impact your overall returns. You must read the policy document carefully. So, how does a ULIP compare to a traditional insurance plan, like an endowment or money-back policy? Traditional plans are low-risk products. They offer guaranteed returns, but these returns are often quite low, sometimes barely beating inflation. ULIPs, in contrast, offer potentially higher returns, but with no guarantee, as they are market-linked. Traditional plans are simpler and less transparent about their cost structure, while ULIPs offer more transparency and flexibility with fund choices and switching options. Your choice depends on your comfort with risk and your financial goals. Ultimately, a ULIP is suitable for someone with a long-term investment horizon, typically 10 years or more. It is for individuals who understand market risks and want the potential for higher returns, along with life insurance. If you are a disciplined investor who can stay the course through market ups and downs, a ULIP can be a powerful tool to achieve goals like funding your child's higher education or building a retirement corpus. It combines protection, growth, and tax savings into one comprehensive package, making it a smart choice for the informed and patient investor.